Hi everyone, welcome back to another lesson. If you're new to this channel, my name is Farhan and I help accounting students like you ace your exams. Today we have got a practice question taken from a past exam, which is paper 2 October-November 2021 exam, and this is the variant 22 for the IGCSE code 0452. Okay, so this is question number 5, where we are mainly working with preparing the asset at cost account, followed by the provision for depreciation act account, and lastly, the disposal account. We will also end our lesson with a discussion between comparison of the reducing balance and the straight line method. You can see the question on the left hand side of your screen, and on the right hand side, we've got all the workings, which I'll go through and explain to you step by step. What I mainly need you to do now is focus and follow through for an excellent understanding so we can get full marks in the main exam. With that being said, let's begin. Simon has a business selling office stationery. On the 1st of January 2019, he owned 2 delivery vehicles, which has been purchased on 1 January 2018. Delivery vehicle A had cost $30,000 and delivery vehicle B had cost $25,000. So we understand that Simon has a business, and on the 1st of Jan 2019, we have 2 assets. The total cost of these 2 assets at 1 Jan 2019 is $55,000. But these assets were actually purchased on 1 Jan 2018. And in the third paragraph, we know that the straight line method for depreciation is used, okay, for both the delivery vehicles, and the rate of 20% is applied per annum on the cost, with the rate being applied for each part of the year for which the delivery vehicles are owned. So this is referring to a proportionate depreciation to be applied based on the number of months each of these vehicles were used in an entire year. Due to a decline in business, delivery vehicle B was sold on 31 March 2020 and a check for $10,350 was received. Delivery vehicle A was still in use at the end of 2020. So we understand some kind of disposal has taken place, which is the delivery vehicle B, but that happened in the year 2020. Now, the requirement in the first part of this question is to complete the 3 accounts of delivery vehicles, the provision for depreciation, and lastly, the disposal account. So before we can do that, we also need to ensure that our workings are as detailed as possible for full marks, and also ensuring that they're error-free. So if I can have your attention to the right-hand side where we have got all the workings, and we'll start by preparing the asset at cost account, which is the delivery vehicles ledger account itself. All right, so we understand that the total cost of the 2 vehicles, $30,000 for vehicle A, and $25,000 for vehicle B, added together is $55,000. And we are starting the year on 1 Jan 2019 with an opening balance, which is balance brought down of $55,000 recorded on the debit side. Why is it on the debit side of the delivery vehicles ledger account? When we think of the delivery vehicles account, it is an asset account, and all assets by default must have an opening balance on the debit side, which also means when they increase, we debit it. When they decrease, we credit it. So at the 1st of Jan 2019, we are carrying forward the opening balance. We are carrying forward the closing balance from previous year. So we are beginning with an opening balance of $55,000. And we understand that in between 1 Jan 2019 and 31 December 2019, no assets were sold, nor any assets were purchased. We're quite confident. That means at 31st of December 2019, we just simply carry down a balance of $55,000 to ensure equals on both sides. Then, when we move to the new financial year, starting 1 Jan 2020, this closing balance of $55,000 from 31 December 2019 gets carried forward as the opening balance at 1 Jan 2020 of $55,000. So we are writing balance BD, which is balance brought down. And during this year, we understand that an asset has been sold. So on the 31st of March, an asset has been sold, which is delivery vehicle B. what was the cost of delivery vehicle B? $25,000. So when assets are sold, we are obviously having a disposal. Does that also not mean that this asset is no longer remaining in the books? Therefore, within this ledger account for assets, we have to reduce our asset account by including this on the credit side. So we can see that at 31st March 2020, we are selling delivery vehicle B for $25,000 with the relevant cross-reference in the details column is the disposal account. So we understand that the asset we sold was $25,000 in original cost. And we are recording it on the credit side because obviously our assets are decreasing. When assets decrease, we credit them. So what's happening is that at the end of 31st of December 2020, we have a balance that we're carrying down of $30,000 to ensure equal debits and credits of $55,000, right? So that means we are carrying forward this closing balance at 31st December 2020 as the opening balance on 1 Jan 2021, which is balance brought down of $30,000. Now, most students, they fail to record the opening balance again in the next financial year. I need you to remember that every time you're preparing a formal ledger account, always carry forward the closing balance as the opening balance in the next financial year, okay? Now we have the provision for depreciation of delivery vehicles account. And here I need you to understand some things. So we understand that both these assets were purchased on the 1st of Jan 2018, and the total cost of these two assets are $55,000. So year one for usage of these two assets would be from 1 Jan 2018 until the end of 31 December 2018. And in this year, a full depreciation is to be applied for these two assets because they were in use throughout the entire year. So we multiply 20% simply on the cost of $55,000, which is $11,000. So this is the balance that they have already provided us at the beginning on 1 Jan 2019, balance brought down of $11,000, which is the total depreciation at end of 31 December 2018, which we have just proved, which is $11,000. Now, why is this recorded on the credit side? Provision for depreciation on motor vehicles is a contra asset account. And contra asset accounts are mainly prepared to reflect the reduction for a relevant non-current asset account, and the relevant non-current asset account in this case is obviously the delivery vehicles account. So whatever usage these delivery vehicles will go through, that will end up incurring an expense, which is the loss in the value of these assets through the consumption of economic benefits as it helps the business generate more revenue. So all this value, which we think are being lost from this asset, is some kind of provision. So we store it in a separate account, which is the contra asset account. And we are recording it on the credit side. And by default, all contra asset accounts must have an opening balance on the credit side. So we obviously understand the definition of contra asset, which is mainly an account prepared to record all the reduction for a relevant asset account. So whatever reduction the cost account would go through, that would be kept separate in this provision account, which is the contra asset account. So we start the year on 1 Jan 2019 with an opening balance of $11,000, which we have already proved. Now let's look into the entire year of 1 Jan 2019 until the end of 31 December 2019, which would be year two for usage of these assets. Now vehicle A is to be depreciated at 20% on the original cost of $30,000, which would give us $6,000 in depreciation. Vehicle B is to be depreciated at 20% on the original cost of $25,000, which would give us $5,000 in depreciation. And the total depreciation for these delivery vehicles combined would be $6,000 plus $5,000, which is $11,000, which is an expense which would be reported in the income statement, right? So that is why when we include this within the ledger account at 31st of December 2019, we are including the total depreciation of $11,000, and we're including this on the credit side because when we prepare the journal entry for recording depreciation expense for the year, how do we journalize it? So we debit the depreciation account, and then we simultaneously credit the provision for depreciation account. Isn't that so? Because obviously contra assets are increasing on one hand, where the total depreciation is being added up from one year to the next, and all contra assets, when it increases, we credit them. We understand that. And obviously an expense is also increasing, which is the depreciation expense of delivery vehicles for the specific year starting 1 Jan 2019 and ending 31 December 2019, which would be 11,000, and this would be obviously reported in the income statement. So you can see the provision for depreciation account is mainly being credited in the journal entry, which is what we have done in the ledger account on the credit side to record the $11,000, and the relevant cross-reference used is the income statement in the details column, okay? So altogether, 11,000 and 11,000 added up gives us 22,000, which means the balance that we need to carry down at end of 31 December 2019 must be 22,000 to ensure equal debits and equal credits. Now we move to year 3, and we do understand that vehicle B was sold in year 3. So year 3 would start at 1 Jan 2020 and end at 31 December 2020. And vehicle A was in use throughout the entire year. Therefore, a full depreciation is to be derived, similar to the previous years, which is calculated at 20% multiplied on the original cost of $30,000. That gives us $6,000. Then we have got vehicle B, which we sold on 31 March 2020, and it was used for 3 months, right? So that means the depreciation is calculated on vehicle B using a proportionate method, where we first multiply 20% annualized rate with the total cost of 25,000. Then we adjust it for the 3 months, which are the months of January, February, and March that it has been used in the year 2020, out of the 12 months that are available in the year 2020. So that's why we're multiplying it by 3 over 12. That gives us a total depreciation for vehicle B in the year 2020 to be $1,250 for the 3 months of usage. So altogether, the total depreciation for the year 2020 for both these vehicles combined is $6,000 for vehicle A, added to $1,250 for vehicle B, which is $7,250. And based on the journal entry we had done in the previous year, we understand when we record depreciation expense in card for the financial year, we debit the depreciation expense of delivery vehicles account, and we would credit the provision for depreciation account. So as we understand, the provision for depreciation account is being credited on the ledger account itself. When we start the opening balance at 2021 Jan with 22,000, then we credit an extra 7,250 at 31 December 2020, and the relevant cross-reference in the details column is the income statement, obviously where the expense amount is reported. Okay? Now, we want to know the total depreciation for vehicle B since the day it was purchased, which was on 1 Jan 2018. So from 1st of Jan 2018 until the end of 31 December 2018, vehicle A had a depreciation of $5,000. How did we derive it? 20% multiplied on the original cost of 25,000. The same thing to be applied in year 2019, where vehicle B wasn't used throughout the entire year. So the depreciation is calculated again at 20% multiplied on 25,000. But in year 3, this asset was only used for 3 months, which are the months of January, February, and March. And based on our calculations, it's $1,250 for the year 2020. So the total depreciation for vehicle B, which has been sold, is $11,250. Every time an asset is sold, what happens? The first effect is to remove the cost component from the total cost showed for assets, and then to also reduce the relevant depreciation by the depreciation, total depreciation for the asset which we have sold, which in this case is 1250. So we understand that in the provision for depreciation account, there is no point of keeping the records for this asset in future years. So therefore, we need to remove this effect. So now that we are reducing the provision for depreciation, what do? We obviously debit it. So at 31 March 2020, which is the day the asset was sold, so you got to be specific with your dates, we are showing that this total depreciation of 11,250 is being removed from the books because of the fact that this asset has been sold, which is validated again by transferring this through the disposal account, as mentioned here in the details column. All right. Now, so we want to find the net total. So obviously we understand that on the credit side for the year 2020, we have a total of 29,250, which must be the same on the debit side. And for us to achieve that, we need to bring a closing balance of $18,000, right? So at 31 December 2020, the balance carried down is $18,000, which gets transferred as the opening balance on 1 Jan 2021. Obviously on the credit side, that is $18,000. And this is on the credit side because we clearly understand that contra asset accounts are always credited. So which means by default, their opening balance must be credited, and when they increase, they're credited. All right, so the last ledger account to complete would be the disposal account. Now, I also need you to understand some things which we have discussed to some extent already, but let's go through it again. So we understand that vehicle B was sold, right? And when vehicle B was sold, we no longer have this asset in our books. It belongs to some other guy or some other business. So obviously we have to first remove the cost of this specific asset from our books. We understand assets when the increase we debit it, but now that we have sold it, we have a decrease. So obviously we'll be crediting the delivery vehicles at cost account by 25,000. But the simultaneous debit entry or the corresponding debit entry would be to transfer this through the disposal account of $25,000, which is the main reason behind why we are removing this cost at the first place. So as you can understand, based on the journal entry, the disposal account is being debited. What does that mean for us? So within the ledger account for delivery vehicles disposal, we would record on the debit side $25,000 at 31 March 2020, the day the asset was sold. And because we're removing the cost, the relevant cross-reference for the account that we mentioned in the details column is the delivery vehicles at cost account, which is the very first account we prepared today. Then we also have to remove the total provision for depreciation for this asset. Obviously, as we understand, there's no point of keeping this in the books for New Year's because we don't have this asset anymore. So provision for depreciation in itself is a contra asset account, we understand, which means when it increases, we credit it. But now that it is decreasing, due to the fact that we have sold it, we have to debit the provision for depreciation account by 11,250, which you have already seen in the previous ledger account, right? So the simultaneous of the corresponding credit entry would be to credit the disposal ledger account by 11,250. So what that means for us is that on the credit side of the disposal account at 31 March 2020, the day the asset was sold, we record 11,250 with the relevant cross-reference for the account used in the details column to be the provision for depreciation of delivery vehicles. So you can see I'm writing it in short form, but in exam, if you get enough space, if you're writing it on paper, you can write the entire words. Okay. Now, let's understand if we have got any profit or loss from the sale of this asset. Now, the carrying amount or the net book value can always be derived at the end of a financial year, which is simply the difference between the cost and the total provision for depreciation. And the total provision for depreciation is all the depreciation expense that has been incurred so far since the day of purchase. So based on our calculations and information that we already know, the original cost for the asset, which is delivery vehicle B is $25,000, right? And the total provision for depreciation we derived is 11,250, which means the net book value or the carrying amount should be 30,750. Now, the carrying amount or the net book value at any given point in time refers to the economic benefits that are still available for consumption by the business to help the business generate more revenue, right? So obviously, this is the stored value within that asset. And based on the question, so I'll just scroll back up a bit, you can see that in the last paragraph, it's mentioned that the check of $10,350 was received. So we understand the value that was remaining within this vehicle was 30,750, but we sold it for 10,350, which is what we formally refer to as disposal proceeds, right? So does that not mean that we sold the asset at less than what it was worth at this point in time, which means we have made a loss. And the amount for the loss is the difference between 13,750 and 10,350, which is $3,400. And loss on disposal of a non-current asset is an expense. Always remember, all losses that a business incur is an expense because it is some kind of cost to the business. And all income is always obvious. All revenue is always income, or all commission income, all those things. So expenses are always debited and income is always credited. I also need you to remember that. And loss being an expense must always be also debited, right? Okay, so now let's understand the two sets of journal entries that we have here. So when we are receiving check, our bank account is increasing in value because the check is directly deposited in the bank account, which is an asset account in itself, and we understand that when assets increase, we debit it. Simultaneously, we credit the disposal account by $10,350. The reason we received the check is because we sold the asset, right? So now let's go to the disposal account, and we understand it is being credited due to the fact that we have received funds in our bank account. So we are using the bank account as the cross-reference in the details column. And then we have a second set of journal entry where we understand that we have made loss, and all losses are expenses, and all expenses are to be always debited. So we debit the loss on disposal, right? And simultaneously, we would be crediting the disposal account. The loss on disposal is an expense account, which is obviously going to be reported in the income statement. So in the disposal account, what you can write on the credit side as the relevant cross-reference, the details column, is income statement, which is basically referring to the fact that you have made some kind of loss, all right? And that would be $3,400. So if your disposal account is prepared correctly, it should automatically balance with equal debits and credits on each side. And that would be 25,000 on both sides with nothing to carry forward because it is supposed to balance. If you've got anything left to carry forward, that would be a mistake, okay? All right. All right, so now let's look into the last part of this question. So Simon's sister, Yasmin, is also in business and depreciates her delivery vehicles by the reducing balance method. Simon is considering whether to apply the reducing balance method of depreciation to his vehicles. Advise Simon whether or not he should be applying the reducing balance method of depreciation, and make sure you justify your answer. Now, this is a 5-mark question, and you can easily score full marks. And the way these marks are applied is 4 marks are basically for you measuring the pros and cons or talking about the differences or the similarities between the two methods. And then lastly, having a proper justification when you're recommending. Now, let's understand what each of these two methods really are. So when we start with the reducing balance method, it is more suitable for assets which we expect to use more in the earlier years of usage for that asset. And in this case, we are obviously working with delivery vehicles, but this is more suitable for technological items. So whenever a new phone comes out, for instance, like you get excited and you can extract more benefits, or whenever a new technological device comes out, a new iPad or a new computer or a new microphone or a new camera. So you expect to earn more benefits in the earlier years of usage because you understand eventually tech gets upgraded, right? And there will be always new stuff coming out. So for those items, the reducing balance method would be more suitable, where we expect that more benefits are consumed in the earlier years of usage. And when we use the reducing balance method, we can also capture a realistic net book value or the carrying amount because we derive it at the end of every year. But that also requires us to recalculate depreciation every year based on the net book value that we start the year with, which refers to the economic benefits still available for consumption. So I've already given you 3 points. If you were to discuss about the reducing balance method, and then if you were to use the straight line method, it is pretty much a straightforward calculation, and it is more suitable for assets which we use same, like similar every year, right? And it's also suitable when equal economic benefits are extracted, where we want to match the expense incurred against the revenue earned every year. But a key important point is that the violation of the consistency accounting concept, where similar methods should be used and not changed, because it prevents comparison in terms of decision making and analyzing business performance, right? So if you were to recommend either of these two methods, I would suggest you recommend the straight line method and that Simon sticks to it, because it does violate the accounting concept of consistency. And also, you could include some pros within your recommendation by mentioning that it is easier and straightforward to calculate. And we understand that both these delivery vehicles are depreciated at the same rate of 20% per annum. We could just source equal benefits every year. But if you decide to recommend the reducing balance method, then you could bring that argument that vehicles have more efficiency in the earlier years of usage, because it is some kind of technological item to begin with, and it goes through wear and tear and obsolescence as you use it more within your business. So the main purpose here is to understand how much benefits can we consume on an annual basis, all right? So you could recommend either of these two methods as long as you can write the sentence correctly and mention the points, okay? And obviously discussing what the reducing balance and straight line method are to begin with. All right. So that's all for this question, and that's exactly how you get a 20 out of 20. And this question is quite common in every year. Maybe some complications here and there are involved, but I believe you guys will be all fine. So if you found value in this content, make sure to drop a like and subscribe to this channel, and check the links in the description to apply for our mentorship program. And if you have got your exams coming up very soon, we also have an intensive program. All you have to do is apply and click in the form, and also discuss this with your parents. With that being said, I'll conclude today's lesson, and I'll see you in the next one.